Hello and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. My name is Pushpendra Mehta, and my guest for today is Craig Jeffery, Managing Partner at Strategic Treasurer. Welcome back to the Open Treasury podcast, Craig.
Good to be here, Push.
So, Craig, in our review of current Treasury news and developments, our discussion will focus on a short list of key items. Today's Open Treasury podcast will cover three sections. The first one revolves around the economy. The second section focuses on corporate hedging. And the third section covers central bank digital currency and blockchain. These three sections highlight 5 headline stories coming up through CTMfile.com. Craig, let's get started with the first section, shall we? The IMF, or the International Monetary Fund, is of the opinion that the Russian-Ukraine conflict will significantly slow down the recovery of the world economy this year. In addition to lowering the growth outlook for Eastern European countries, the IMF has warned that countries globally will also experience commodities market turmoil as a result of the war. Also, as we all know, China's COVID wave has resulted in severe lockdowns that has blocked major economic hubs such as Shanghai. This will adversely impact the already stretched global supply chains. So, Craig, my question to you is, do you concur with the IMF's forecast and see an economic contraction or recession plaguing the world economy?
The question about what's IMF saying and how that relates to what almost every other economist is saying is consistent. It's either growth will slow, and in some cases it will pull back. The IMF took a haircut on the overall global GDP, and it doesn't sound like it's that much. It's increasing to 3.6% this year, which is a notable, 0.8% pullback from January, where they're looking at a 4.4 annual increase. And, they also have a muted decrease next year. So pretty common across the board. There's more that are more negative in terms of expecting a greater pull down, but high points or highlights is that Russia, they expect their economy to shrink by 8.5% from a 2.8% growth. So that greater than 11% shift is pretty dramatic, showing the level of expected impact of these sanctions. So I think all those things that they said make sense. It seems like they're being cautious on how much is going down. But if you look even at the U.S., they think the growth will slow to 3.7% in the U.S. compared to 4% just a few months back. So larger economies, those less impacted by Russia's commodities, will have a lower impact. So yes, I would concur what they're saying there. They seem to be providing a very cautious approach, but it's growth is slowed or negative depending on what country you're in.
So, Craig, the second story that's up for discussion in this section is about China's central bank, the People's Bank of China, or PBOC, reducing the amount of foreign exchange that banks must hold as reserves in a move to slow the depreciation of the yuan, which is at its weakest levels since 2015. So PBOC has said that from 15th May, it would cut the foreign exchange reserve requirement ratio by 100 basis points to 8% to improve financial institutions' ability to use foreign exchange funds. Craig, do you think this reduction in the reserve requirement ratio, that means releasing US $83.2 billion into the banking system, is a step in the right direction to boost the faltering economy? And will it ensure that the financial or the banking system has sufficient liquidity to help sectors that have been hit by the COVID-19 pandemic in China?
As I looked at what China's doing and what other banks are doing, particularly vis-a-vis the U.S. Fed, the increases and the expected increase in rates that are being charged will make U.S. dollars more attractive. You also see the weakening of the yuan, so the People's Bank of China is reducing the FX requirements, which is another way of reducing the level of currency that has to get transported over. So they're doing this as a move to support the yuan, in tough times, whether it's geopolitical issues or economic issues. Money tends to move and flight to high quality, which is in these years and decades has been the US dollar. And so this is trying to stabilize their country's activity. So they have a certain number of tools in their toolkit, and this is one of them to slow that change. I think it only mutes what's happening in the globe economically.
Moving forward to the second section, our first story is about European corporates gaining 3.8 billion euros or 4.15 US billion dollars from commodities hedging, as reported by Eurofinance. This is supposed to be a relief to European automobile and consumer goods multinationals, but Eurofinance warns that protection will fade as hedges expire and cost of new ones catch up with today's prices. Craig, do you think that despite these gains, hedging is only a stopgap solution and other tools for commodity risk management are necessary?
The situation where there's severe commodity price volatility shows the value of some of these commodities hedging programs, blunting the negative impact. Now, this is getting 3.8 billion euros in relief sounds great. And that's compared to a much larger loss. But I think we have to remember that the underlying exposures of these companies are higher. And so it's blunting the impact and the whipsaw effect of some of these drastic shifts in pricing. The reason for hedging commodity prices is to bring your risk and your exposures in line with, certainly within your risk capacity, but certainly within your risk appetite as well. And this is a way of blunting the gyrations that occur when this happens. It's going to be expensive because people are seeing a higher level of risk. But I think this just shows the strength of many of the treasurers and risk managers who are helping their organizations weather some of these large gusts of price differences. So hats off to them. But I think what Eurofinance has said is exactly right.
The third section, Craig, we will discuss revolves around blockchain technology and central bank digital currency, or CBDC. As the financial industry starts to shift their interest towards digital asset services, firms are actively considering blockchain as a viable option, cryptocurrency trend that was once avoided. Recently, BlackRock, JP Morgan Chase, and Goldman Sachs are some of the major financial institutions that have responded to the growing demand for digital asset services from clients and are suggesting plans to adopt blockchain technology at a larger scale. The moves by these financial heavyweights underscore how far Wall Street firms have come in accepting digital assets. For years, a number of financial institutions were vociferous dissenters until soaring crypto prices and a flood of investor money drove home the point that staying on the sidelines meant missing out. My question to you is, are these financial institutions embracing crypto and blockchain to stay competitive, or are there other reasons to do so?
Maybe we could bisect the two titles, both blockchain and crypto. On the blockchain side, using this distributed ledger technology that allows independent verification of activity holds significant promise. That's long viewed as holding significant promise for all types of trade and supporting that type of trade. And so that certainly to me makes a lot of sense, from whether it's BlackRock, JP Morgan, Chase, Goldman Sachs, et cetera. They're taking advantage of some of that technology and seeing its value towards this confirmation type technology, helps and supports trade. To the extent that we also look at crypto, it is notable that there's a significant interest among some of these behemoths. JP Morgan, multi-trillion-dollar bank, released a JPM coin. They've got an announcement coming up in May. These are, I don't know if you want to call it dipping your toe in the water, but they're certainly learning and growing from, exploring different types of digital assets for settlement, for trade. this is significant that these organizations are diversifying what they do beyond just blockchain, but towards digital currency. So given the level of interest, I think we have to be mindful, watchful to see what goes on. I think some types of digital currency are far less attractive to banks and to the government regulators. So central bank digital currency, some of these bank offered stable price coinage or coins should have a greater possibility than some of the other ones that may carry a lot of exciting trader news. But there's a reason why there's a lot of attention paid to these types of technologies and ways of settling trade and confirming different elements of the trade process.
Moving forward, the next story for discussion focuses on central bank digital currency and Mexico's plan to launch its own CBDC within the next 3 years. Is Mexico intending to roll out its CBDC to enable greater financial inclusion for its citizens while expanding existing payment options? Or is it because it doesn't want to be left behind in the CBDC race, even as over 100 countries are exploring CBDCs?
It is probably both. I mean, the fear of missing out, or FOMO, is very relevant across the different central banks. I mean, every week there's more news based on this country, that country. We've talked about some of those items there. The fear of missing out is certainly a component, I think, to every central bank who's looking at their central bank digital currency. And the fact that they're looking at putting something into play by 2024 means they have a longer term horizon to get this launched, and they're looking at it. So that's helpful to the point that it makes greater participation available. I think that's likely true. The growth of the use of cell phones to be able to handle different types of currency is another area that has, I guess in a way, it democratizes the ability to use currency in different forms. And I think all of this is a progression towards greater openness and greater use across the board. So I just find it interesting to see these stories popping up every single week from country after country about what they're doing on the digital currency. So so fun stuff here.
Yeah, and good to see how interoperability works out between these countries as well, going into the future. Finally, Craig, what is your choice for the biggest or the most important story of the past week, and why?
On the economy, I'm going to put that in second place. The idea that there's a significant amount of activity, expectations of slowed growth, and in some cases, decreasing GDP. I think China's responding to that. I think that's a little bit longer of a trend. It's like a ocean liner. It's hard to steer that, but we're seeing it take a significant turn. The bigger issue here is this shift towards blockchain by the major financial firms. I think we continue to see this grow, and this summary of some of the largest financial institutions in the world spending significant time and energy on this signifies something much more permanent and significant. So I'm going to go with the blockchain adoption by major financial firms as my top story this week. How about you, Push? Where are you?
Craig, for once I would have a different opinion. I beg to differ with you. Well, I completely agree that it's a very important story because blockchain, technology, also its connection with digital assets and CBDCs. So it's obviously a very important story. Somewhere maybe I'm a little biased. I'm a little concerned about the world economy. Just the fact that there is a spiral story going on at a different level with the, country risk survey done by Euro Money recently, where they downgraded 107 of the 174 countries since December. So my concern is, the Ukraine invasion, if this war continues, inflation, food crisis, the global economy, so economic contraction, economic downturn, slowdown. So I would probably go with the IMF forecast story as my top story of the week. But anyway, Craig, a big thank you to you as always for your discerning insights, and to our CTMfile audience for joining us on this edition of Open Treasury. Please subscribe and look in the show notes for the article links. Thank you so much.
This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.